Welcome back to another video for HNDA second year Advanced Financial Accounting. In this video, we are going to learn how to do the consolidated financial statements. This video covers the following areas. Firstly, you may learn how to do the goodwill on acquisition based on SLRFS 3. Then you may learn how to do the impairment of goodwill as well as amortization of intangible assets. Since this is a group of company, you may learn how to settle the balances in the current accounts and how to treat the intercompany dividends. Further, you may learn how to treat the unrealized profit on sale on inventory both by parent to subsidiary as well as by subsidiary to parent. Then you may learn how to treat the unrealized profit on sale on non-current assets by parent to subsidiary as well as by subsidiary to parent. I'm going to use the tutorial 2 to cover up the whole adjustments. You may find the link in the description box to obtain the Word document relating to tutorial number 2. South PLC has acquired 70% of East PLC on 1st of October 2012. You can see there is a controlling interest over the East PLC by the South. Therefore, South PLC is the parent company and the East PLC is the subsidiary company. And the acquisition made on 1st of October 2018. Now you can see the statement of comprehensive income for the year ended 31st March 2023 for both South and East PLC. Now you can see the statement of financial position as at 31st March 2023 for both South as well as East PLC. Everything is in rupees thousands. I'm moving to the additional information of the tutorial. Let's start with first additional information. You have to remember in these additional information, everything is presented in thousands. Now when you read this one, it's difficult to identify every transaction at once. Therefore, I'm going to segregate it between each and every element which is have a significant impact on the financial statement. It's given that fair value of the net identifiable assets of East PLC was greater than 30,000 in comparison to that of the book on 1st of October 2018. And 50% of this excess relating to the property, plant and equipment. Therefore, first we are going to transfer the increment of the fair value into the fair value adjustments. We are going to credit it. We can take it as a reserve. Then 50% we are going to transfer to the property, plant and equipment, which means 15,000. Then it says the rest is related to internally generated intangible assets. Therefore, the balance 15,000 we are going to transfer it into the intangible assets. So now you can see the double entry. Now let's see the impact on the consolidated statement of financial position. Therefore, the increment of the fair value which is relating to the property, plant and equipment 15,000 we have to add in the consolidation. And at the same time, we have to create another additional asset which is known as the intangible assets. Therefore, we have to add the rest 15,000 into the intangible assets. Total of 30,000 should credit to the fair value adjustment. This is a capital sort of reserve in the consolidated statement of financial position. You can utilize it and you can distribute among the parent as well as the non-controlling interest later. It says that in the question, the useful life of the intangible asset was estimated to be 10 years from 1st of October 2018 and should be written off on straight line basis. Therefore, we have to take this intangible assets, which is 15,000, and we have to divide it by the useful life to calculate the amortization per year. Accordingly, the amortization per year is 1,500. Then we are going to consider it under the operating expense. And 30% of this is relating to the non-controlling interest. Therefore, 31st March 2023, the current financial period, we have to amortize this asset from the purchase date or from the creation date up to now, which means we have to amortize 5.5 years. Therefore, the total amortization expense is 8,250. That is 1,500 into 5.5 years. In the income statement, under operating expenses, the amortization 1,500 should recognize. At the same time, under the profit after tax, which is attributable for non-controlling interest, we have to reduce this amortization. This non-controlling interest is starting with the East PLC's profit after tax. Therefore, first we are going to take this 30,000. From that, we are going to deduct this amortization 1,500. When it comes to profit or the total comprehensive income, which is attributable for non-controlling interest, we can do it in two different ways. One way is we can take 30,000. For that, we can add up all the other comprehensive income, that is gain on translation of foreign operation 2,000 and gain on retirement benefit plan 3,000, which is relating to East PLC. Or other than that, what we can do, we can get the total comprehensive income of East PLC, which is 35,000. From that, we can deduct this amortization 1,500. This amortization has occurred after the acquisition. Therefore, what we are going to do is, from the post-acquisition profit from East PLC, we are going to reduce it. Therefore, post-acquisition profit of East should be debit by 8,250 as well as intangible assets which has been created should be reduced by this amount. Therefore, we are going to credit intangible assets by 8,250. Therefore, in the statement of financial position, under intangible assets, we are going to reduce 8,250. Now, let's move on to the second additional information. It said that retained earning of East PLC stood at balance of 20,000 and other reserves belong to the post-acquisition period. Therefore, we have to take into the consideration of fair value of net assets the pre-acquisition reserves of East PLC. Based on the information, let's analyze the retained earnings of East PLC. According to the statement of financial position, East PLC have 65,000 in the retained earnings, and it says that 20,000 is the pre-acquisition, which means the balance 45,000 is relating to the post-acquisition profit. In the adjustment 1, we have calculated amortization for the intangible asset over the period is 8,250. And I told you it is relating to the post-acquisition profit. So in the consolidation, what we are going to do is from the post-acquisition reserves of 45,000, we are going to remove this 8,250 in the consolidation. So let's calculate the goodwill based on the information given. So in the goodwill acquisition, first we are going to put the investment, that is 109,360. For that we have to add the fair value of non-controlling interest, which is 50,000. Then the total add up to 159,360. From that we have to deduct, or we have to reduce the fair value of net assets. So here we have to take the share capital 80,000, and we have to take the pre-acquisition reserves, which is 20,000, and we have to add the fair value adjustment, that is 30,000. So altogether fair value of net assets be 130,000. Then the goodwill is 29,360. Now you know that this goodwill belongs to both controlling interest and non-controlling interest. Therefore, we have to see what is attributable for the non-controlling interest. For that, first we are going to take the fair value of non-controlling interest, which is 50,000. Then from that, we have to deduct the non-controlling interest in net assets at acquisition. That is 130,000 into 30%. The total value is 39,000. So, the goodwill attributable to non-controlling interest be 11,000. When we deduct this value from the total goodwill, we are getting the parent's portion of 18,360. Let's look at the impact on the above transactions in the consolidated statement of financial position. First step is we have to transfer the investment in East PLC rupees 109,360 into the cost of control or the controlling interest to calculate the goodwill. You know that the South PLC invested this amount for 70% share of share capital and retained earnings 70%. At the same time, they have invested some money for the increment in the fair value. So 21,000 is relating to the South PLC. They have invested this amount for the East PLC for their ownership. And the balance 24,000 is relating to the non-controlling interest. That is the share of share capital which is relating to non-controlling interest. Then from the retained earnings, you can remember 20,000 is the pre-acquisition. So out of that, 30% relating to non-controlling interest, which is 6,000. That is relating to the non-controlling interest. Then from the fair value adjustment 30,000, 30% which is 9,000, is relating to the non-controlling interest. Now, we are getting the fair value of the investment. So, by using the calculations, we have found that the goodwill is 29,360. Out of that, 11,000 is relating to the non-controlling interest. When we add these values together, 24,000 of share capital, 6,000 of pre-retained earnings, 9,000 of fair value adjustments, as well as the goodwill, we are getting 50,000. This 50,000 is the fair value of non-controlling interest. Check and see whether you are obtaining this value. In the third adjustment, it says intercompany transactions should be recorded via current accounts except intercompany dividend. And in the fourth one, it says the company's proposed dividend as follows. South PLC 20,000 and East PLC 10,000. Let's see how we are going to account it. We know that from the dividends given by the East PLC, 70% is for South PLC or for the parents. Therefore, from the dividend receivables, we are going to remove the dividend receivable by the East PLC. Then, under the dividend payable, we are going to remove that portion as well. So, the remaining will be the dividend relating to the non-controlling interest as well as the parent. In the fifth adjustment, it says East PLC has sent remittance of 25,000 to South PLC for goods purchased. The remittance was not received to South PLC by the close of current financial year. You know that these remittances are direct cash receipt. So we have to account it in the statement of financial position. From the current account balance with East, we are going to remove this remittance value 25,000. And since this is a direct cash receipt, we are going to add it to the cash and cash equivalent. Now, we are moving to the next adjustment. Here it says the difference between current accounts are due to goods in transit. So let's identify what is the value relating to the goods in transit. In the SFP, we have to remove these intercompany transaction in the current account. Therefore, in the current account, first we are going to set off the current account with South PLC with the East. Therefore, we are going to remove 20,000 from the current account with South PLC. At the same time, we are going to remove it from the current account with East. So, there is a difference of 25,000. That is 70,000 minus 25,000 minus 20,000. So this is recognized as a good in transit. So we have to add it to the inventories in the consolidation. Now, in the next adjustment onward, we are going to identify how we are going to treat intercompany sales. Goods sold by parent to subsidiary. Let's move into the next adjustment. It says South PLC has sold goods to the East PLC. So when the subsidiary receive goods or when the parents sell goods to subsidiary, it is known as downstream sales. It says they have sold 24,000 invoice price worth of goods. Now, out of this, it says that 12,000 remained at the stores, which means this is the unsold stocks in the East PLC. Now we have to calculate the unrealized profit. In the latter part of the adjustment, it says South PLC invoice goods to East PLC having added margin of 20% on cost. So normally when a margin is indicated with the cost, it's also known as the markup price. So when the cost is 100, we are assuming the profit is 20%. Therefore, the invoice price or the selling price will be 120%. Now, what we are going to do, we are going to calculate the unrealized profit of the unsold stocks. So, what we are going to do, we are going to take 12,000 and we are going to take 20 by 120 to calculate the unrealized profit. So, the unrealized profit here is 2,000. First, what we are going to do is in the consolidated statement of comprehensive income, we are going to remove this intercompany sales. So we are going to remove 24,000 from the revenue as well as the cost of sales. Then the unrealized profit we have to remove from the gross profit. And we have to add it back to the cost of sales. Why? You know that due to this unrealized profit, our closing inventory value has been increased. Therefore, cost of sales has been reduced. Therefore, we are going to add it back to the cost of sales. Unrealized profit of rupees 2,400 should be removed from the inventories as well as consolidated retained earnings. Can you remember in the sixth adjustment, we found some good in Transist. So now we have to recognize the unrealized profit in those good in Transist based on the profit margin of the parent. Now we know that good in Transist is 25,000. And in the seventh adjustment, it said that profit margin is based on 20% on cost. So let's calculate the unrealized profit. Unrealized profit for 25,000 is 20 divided by 120. So we can get rupees 4,166.666. To ease our work, I have rounded up into 4,167. So in a question like this, if you want, you can round it up. And if you want, you can keep the decimals as it is. As earlier, we have to remove this unrealized profit. So what we are going to do, we are going to remove this 4,167 of unrealized profit from the consolidated gross profit as well as we have to add it back to the cost of sales. So normally In the practical scenario, what we are going to do, we are just going to add back to the cost of sales. And we know that from the revenue, when we minus the cost of sales, we are getting the gross profit. So if you are going to do it in the mathematical form, there is no need to deduct it from the gross profit. It's automatically coming when we deduct the cost of sales from the revenue. But if you are doing it by line consolidation, then you have to remove it from the gross profit. So the profit attributable to Goodwill Transists is removed from the inventories in the consolidation. At the same time, it has to be removed from the consolidated retained profit. Let's look at how we are going to treat goods sold by subsidiary to parent. It says that East PLC has sold goods to South PLC amounting at invoice price of rupees 15,000, which means the subsidiary sold goods to parent, which is worth 15,000. This type of sales is known as upstream sales, and it says 50% remain at the stores of South PLC. So 7,500 is the unsold stocks. Now we have to calculate the unrealized profit. So it says that each PLC invoice goods to South PLC having added a margin of 10% on invoice price. So when the selling price is or the invoice price is 100%, we are going to give a 10% margin. Therefore, the cost price is 90. Now we have to calculate the unrealized profit, that is 7,500 into 10%. So the unrealized profit is 750. As earlier, what we are going to do, we are going to remove this intercompany transaction from the revenue as well as the cost of sales. Then the unrealized profit of 750 should add back to the cost of sales, and we have to remove it from the gross profit. Then what we are going to do is, after the profit after tax, which is attributable for non-controlling interest, we are going to remove this unrealized profit. So the other entry goes to the inventories. So in the consolidated statement of financial position, we are going to remove this unrealized profit from the inventory. Now, in the next adjustment, we are going to learn how non-current asset sale by parent is going to treat in the financial statements. Let's look at the next adjustment. Let's say on 1st of April 2022, South PLC sold a delivery vehicle to East PLC for rupees 10,000, which had a carrying value of rupees 8,000 in the books of accounts of South PLC. On the date of disposal, the remaining useful life of the delivery vehicle as at 1st of April 2022 was 5 years. So based on this, first we are going to calculate the unrealized profit. You have to remember, in this transaction, parent has sold non-current assets to the subsidiary. So to calculate the unrealized profit, what we are going to do, we are going to take the selling price and we are going to deduct the carrying value. So the unrealized profit in this one is 2,000. Now we have to calculate the over or under depreciation. So here, since we have unrealized profit, we know that there is a over depreciation. So here, the depreciation done by East is rupees 2,000. How we are going to calculate? That is the selling price divided by the useful life. and we have to deduct the depreciation required for the group. So we know that already the actual value of the asset is 8,000, that is the net book value. We have to divide it by 5. So per year we are getting 1,600. So the difference between these two is 400. That is the over depreciation. Here the unrealized profit from selling the non-current asset is included in the other income. So we are going to remove this profit from the other income. At the same time, we calculated there is over depreciation. So this over depreciation is included under the operating expenses. Therefore, we have to remove the over depreciation of 400. Here, what we are going to do, we are going to add back the over depreciation into the property, plant and equipment. At the same time, we are going to remove the unrealized profit from it. You can remember that we have removed the unrealized profit in the consolidated income statement, as well as we have add back the over depreciation. Therefore, here what we are going to do is we are going to do the same treatment to the consolidated retained earnings. Therefore, we are going to add back the over depreciation and we are going to remove the unrealized profit. The following adjustment focusing on non-current assets sale by subsidiary to the parent. On 1st of April 2022, East, the subsidiary, sold a machine to South PLC to the parent for rupees 4,000, which had a carrying value of rupees 3,000. In East books on that date, the remaining useful life of the machine as at 1st of April 2022 was 5 years. So here now the East sold for South rupees 4,000. So you can remember in the additional information from the beginning we have mentioned everything is 1,000. So here thousands mean it is 4 million, right? So ignore the zeros. Now we are going to do everything in thousands. So here the selling price is 4,000. Then the carrying amount is 3,000. So you can see there is unrealized profit of 1,000. So if the exam, they haven't provided the carrying value, what you have to do, you have to calculate the depreciation and from the cost, you have to deduct the depreciation and you have to obtain the carrying value, right? So the difference between the selling price and the carrying amount is the unrealized profit. So we have gained 1,000 unrealized profit out of this transaction. Then we have to calculate the additional depreciation. So depreciation done by South or the parent is 800. Actually, the depreciation should be required for the group is 600. That is the normal carrying value divided by 5. So the over depreciation is 200. Let's see how we are going to record it in the financial statement. Since we have recorded the unrealized profit as well as over depreciation in the comprehensive income statement, the only adjustment here is we are going to reduce the unrealized profit from the property, plant and equipment, and we are going to add back the over depreciation from it. Let's look at the final adjustment of the tutorial. That is the impairment test. It says the impairment test was carried out on 31st March 2023 and decided to write off goodwill by 2000 from East PLC. Since impairment is an expense, we are going to add it to the operating expenses. Then it has to be removed from the profit attributable from non-controlling interest. So what we are going to do for the profit after tax, which is attributable for non-controlling interest, we are going to remove this 2000 of impairment. At the same time, we are going to remove it from total comprehensive income, which is attributable for non-controlling interest. In the consolidated statement of financial position, the impairment value should be removed from the goodwill. So we are removing this impairment 2000 from the goodwill value. We know that in this company, 30% is belong to non-controlling interest. So the profit after tax as well as total comprehensive income, which is attributable for non-controlling interest, is based on these 30%. Therefore, what we are going to do for the profit after tax of East PLC, after the adjustments, we are going to take just 30% out of it in the profit after tax as well as in the total comprehensive income. Now we are moving to the final stage of the consolidation. So in this one, we are going to calculate the consolidated reserves and we are going to focus on the non-controlling interest before preparing the consolidated financial statements. Let's see how we are going to calculate the consolidated other reserves. Normally in the consolidation, first we have to take the parent's balance. Parent is the South PLC. For South PLC, in the consolidated statement of financial position, we can see the other reserve balance is 25,000. For that, we have to add the subsidiary share of ownership for other reserves. So in the East PLC, we can see 5,000. Out of that, 70% is related to the group. Therefore, we are going to take 3,500 of the East PLC's other reserves in the consolidation. Now, the total is 28,500. Now, let's analyze the retained earnings of East. You can remember we have analyzed it before to identify the pre-acquisition reserves. Let's look at it again, but in a different angle. So you know that 65,000 is there as at 31st March 2023. And it says 20,000 is belong to the pre-acquisition, which is based on 1st of October 2018. Then, out of this 20,000, 14,000 goes to goodwill calculation and the balance 6,000 is belong to the non-controlling interest. The balance of 45,000 is the post-acquisition reserves as at 31st March 2023. For this, which is belong to East PLC, we have to do all the adjustments but only relating to the East. So you can see there is an amortization of 8,250 of the intangible assets of East. Then it is under adjustment number 1. You can see the unrealized profit of inventory, which is 750. So the East PLC has sold these goods to South PLC. We have to remove this unrealized profit from the post-acquisition reserves. This is come under adjustment number 8. Then we have to remove the unrealized profit on property, plant and equipment, that is 1000. This is the profit which has been obtained by East by selling its property, plant and equipment to the South, and this is come under adjustment number 10. So because of this transaction we have over depreciated, so we have to add it back to the post acquisition reserves, and this is also in the adjustment number 10. Then finally the impairment of goodwill of the East, that is 2000, which is come under adjustment number 11. So now you can see we have to adjust all these adjustments relating to East from their post-acquisition reserves. Just and see whether you are obtaining the balance as 11,800 with regarding to the East PLC. Now let's analyze the retained earnings of East PLC in a different angle. You can remember 65,000 balance is there in the East PLC under retained earnings as at 31st March 2023. Out of that, in the first adjustment, say 20,000 is belong to the pre-acquisition on 1st of October 2018. Then 70% of it relating to the goodwill calculation, that is 14,000, and the balance 30% is belong to the non-controlling interest, which is 6,000. Then it says the post-acquisition reserve is 45,000. Now we have identified there are 11,800 worth of adjustments are there. So we are going to adjust it to the post-acquisition reserves. From the balance, 70% goes to the consolidated retained earnings. That is 23,240. Then the balance of that, which is 30%, is relating to the non-controlling interest. The balance is 9,960. With that note, let's calculate the consolidated retained earnings. Normally in the consolidation, we are starting with the parent's balance. So here, the parent's retained earnings is 180,000. For that balance, we have to do the adjustments relating to the parents. So here we have unrealized profit of inventory, where the parent sold goods to the subsidiary. The value is 2,400. We have to remove that from the retained earnings of the parent. Then unrealized profit of the goods in transit, that is 4,167. Then unrealized profit of property, plant and equipment, where parent had sold non-current asset to the subsidiary. The profit relating to that transaction, we have to remove it from the parent's retained earnings, that is 2,000. Then the over depreciation value should be added back. After doing all the adjustment, we have to take 8,167, which is a negative figure. We have to adjust it from the parent's retained earnings. Then what we are going to do, we have to take the subsidiaries post-acquisition reserves. We know that the subsidiary is PLC. We have to take 70% out of the post-acquisition reserves. That is 23,240. Let's calculate the non-controlling interest. We know that South PLC obtained 70% of East PLC, which means 30% of East PLC is relating to the non-controlling interest. So, in the goodwill calculation, we have identified that share capital 24,000, retained earnings 6,000, fair value 9,000 and goodwill 11,000 is related to the non-controlling interest, and it is appeared as the fair value of non-controlling interest. For that, we have to add the other reserves relating to the non-controlling interest, that is 1,500. Then you can remember we have analyzed the retained earnings. Then from the retained earnings, that is the post-acquisition retained earnings, we have to take 9,960, which is relating to the non-controlling interest. So the total will add up 61,460 as the non-controlling interest. Now you can see the finalized consolidated financial statements. Let's start with the consolidated statement of financial position. So you can see over the assets, that is non-current assets and current assets, which is relating to the individual companies as well as the adjustments, and finally the group or the consolidated financial statements value. So here you can see the total asset worth 838,033. Now you can see the equity and liability balance. So you can see how we have obtained the group balance based on the adjustments of South and East PLC. And finally, you can see the total equity and liabilities add up to 838,033, which means our total assets is equal to total equity and liabilities. Now you can see the consolidated statement of comprehensive income. Here you can see individual companies, balances as well as the adjustments, and finally how we have obtained the group balance. Please note that from the profit after tax, that is 65,783, we have obtained the profit attributable for non-controlling interest, and then we have transferred the balance to the parents, that is 65,783 minus 7,485. The same procedure applicable in the total comprehensive income as well. First, we have calculated the non-controlling interest. Then from the total comprehensive income, we are going to deduct it, and then we are going to obtain the parent's interest. Hope you have gained more knowledge with regard to the consolidation by going through this video. Now, you may learn in my next video how to do the consolidation with the subsidiary. Therefore, subscribe my channel and click on the bell icon to get more knowledge with regarding to the financial accounting.